All right, let's get into it. Today, we're doing a deep dive on a really fascinating company called MTAR Technologies. Now, these guys operate right at the very heart of India's most advanced, most strategic sectors. And it's a story of incredible skill, huge opportunity, and, well, some pretty serious risks, too.
You know, you might not have even heard of them, but MTAR is this critical, almost invisible force. They're the ones making the absolutely essential components that are powering our nation's future in nuclear energy, in space exploration, and yeah, even in the AI revolution. It's a massive story, so let's break it down.
So here's our game plan for today. First, we'll look at what makes MTR a high-precision powerhouse. Then we'll talk about the 3 giant waves it's currently riding. After that, we'll pop the hood and check out the financials. We'll also cover the top 3 red flags you need to know about. And finally, we'll wrap it all up with a final scorecard and verdict.
Okay, let's dive right in. First things first, what in the world does MTR actually do that makes it so unique, so special in India's industrial landscape?
Well, the secret sauce is something called precision engineering. We're talking about manufacturing parts with an accuracy of 5 to 10 microns. Now, to give you an idea, that is literally thinner than a single human hair. So you can imagine, in sectors like nuclear power or aerospace, failure is just not an option. This incredible skill is their superpower, and it creates this massive wall, this huge barrier to entry for any would-be competitors.
And here it is. This one quote really captures the central tension, the core conflict in the MTAR story right from the get-go. On one hand, you have this incredible, almost impossible to replicate skill. But on the other hand, you have this massive dependency on just one customer, Bloom Energy, who makes up about 65% of their total revenue. Now that's a risk we're definitely going to circle back to.
But even with that big risk hanging out there, MTR is being propelled forward by 3 absolutely enormous trends. Think of these as powerful tailwinds just pushing the business forward.
Okay, wave number 1, the AI data center boom. Let's be real, the AI revolution needs a staggering amount of power. It's incredibly energy hungry. To feed that hunger, Oracle recently signed a massive 2.8 gigawatt deal with, you guessed it, MTR's key client, Bloom Energy. And MTR's role in all this? They make the core hotbox assemblies for those exact fuel cells. So they are plugged directly into the AI power surge.
The second huge wave is India's big push into nuclear energy. The government has plans to build 20 new reactors to meet the country's growing power needs. And MTR, with its 50-year track record in this space, is perfectly positioned as either the sole or the main supplier for some of the most critical parts inside the reactor core. This isn't a short-term trend. This is a tailwind that could last for decades. And the third wave is all about self-reliance in aerospace and defense. India's Atmanirbhar Bharat initiative is designed to boost domestic manufacturing in these critical areas. And who benefits directly? MTAR. They're already supplying crucial engine and structural parts to our national champions like ISRO and Hall, not to mention some of the big global aerospace players.
So here's the crucial point. These 3 waves, they aren't just a nice story on a slide. They have translated into a real, tangible order book of nearly 2,400 crore rupees. To put that in perspective, that's more than 3.5 times their entire revenue for the last financial year. That gives them some seriously strong visibility into future sales.
But you know how it is. A great story is one thing, but you've got to have the numbers to back it up. So let's peel back another layer and take a look under the hood at the company's financial engine.
And whoa, right away we see something strange. There's a major disconnect here. Just look at that revenue line. It's been growing at a super healthy 27.7% compounded annually for 3 years. Awesome, right? But now, look at the profit line. Over that exact same period, profits have actually gone down by 4.6% per year. So what is going on here?
Yeah, to put it bluntly, even though revenue grew nicely last year, the company's profitability got worse. The profit margin actually squeezed down to just 7.8%. In simple terms, they're making a lot more money, but they're getting to keep a lot less of it.
And you can see the problem so clearly in this chart. The EBITDA margin, which is basically the company's operating profit as a percentage of its sales, has just collapsed. It's gone from over 29% a few years ago all the way down to under 18% now. This is happening because of a mix of rising employee costs, the expenses of getting new products off the ground, and pressure from some order delays.
So this brings us to the real core of the risk analysis. We've seen the good, we've seen the bad, and now it's time for the ugly. let's talk about the top 3 red flags that anyone, and I mean anyone, looking at this company needs to think about very, very carefully. Here they are in a nutshell. First, that extreme customer concentration we've already touched on. Second, consistent selling of shares by the company's own founders. And third, a very, very demanding price tag on the stock.
Let's start with that first red flag, customer concentration. An estimated 65% of all their revenue comes from that single US-based customer, Bloom Energy. I mean, this creates an almost existential dependency. If anything were to happen to that one relationship, it would hit MTAR and hit them hard.
Now for red flag number 2. The promoters, the founders and their families, the people who should know the company better than anyone, they've sold off nearly 7% of their stake in the company over the last 2 years. This raises a huge question. If the future is so bright with all these amazing tailwinds, why are the insiders consistently cashing out?
And that brings us to the final major risk, the valuation. Based on last year's earnings, the stock is trading at a price-to-earnings ratio of around 228. Let that sink in. That means investors are paying 228 rupees for every single rupee of profit the company makes. That's a price that assumes absolute perfection. It leaves zero, and I mean zero, room for any errors or delays.
So where does that leave us? We've looked at the powerful growth story, the kind of worrying financials, and those big red flags. How do we weigh the opportunity against all those risks? Well, let's bring it all together in our final scorecard.
Okay, so based on the analysis, MTR gets a final score of 58 out of 100, and you can see the conflict right here in the numbers. It scores really high on growth prospects in 8 out of 10. Makes sense, but it gets really poor scores for management quality. That's mostly because of the promoter selling, and especially for valuation, a D rating with just 2 out of 10. Ouch.
And this really gets to the heart of the risk-reward balance. This analysis suggests that the potential upside, if everything goes perfectly, is actually much smaller than the potential downside if things go wrong. It highlights what we call an asymmetric risk at its current price. The scales seem to be tilted more towards potential loss than potential gain right now.
So what's the bottom line? The final verdict here is that MTR is, without a doubt, an exceptional company. It's got a strong technical moat, it's got powerful growth drivers, but the stock price seems to have gotten way, way ahead of the actual business performance.
And that leaves us with one final big question to chew on. For a company like this, one with a real, genuine competitive advantage, but also very clear and significant risks, is today's sky-high price a rational sign of the market's confidence in its future, or is it maybe a sign of market excess? Something to think about.
Before we wrap up, just a quick but really important disclaimer. The analysis I've shared here is for educational and informational purposes only. I want to be clear, I am not a SEBI-registered research analyst or investment advisor.
Investing in the stock market always involves significant risks, and please do not treat any of this as a buy or sell recommendation. The data and charts are all based on public info and my own research notes, so always conduct your own due diligence or talk to a SEBI-registered professional before making any financial decisions.
Now, if you found this deep dive helpful and you want to stay updated with more stress-free investing analysis, do me a favor and hit that subscribe button. And don't forget to press the bell icon so you never miss an update.
And I really want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name down in the comments below, and who knows, it might just be the subject of my next explainer.
Thank you so much for watching, and as always, keep your investing stress-free.